I think there'll be some real value add. And then I had a health scare about 3 years ago, and that's what made me pivot to wealth management. I think a lot of times you'll get from point A to B, buy and hold, a lot of sweat and tears. We buy and hedge, smoother and higher. And if you're interested in learning more, I'll do a quick self plug for a options meetup I run, San Francisco Option Traders. If you go to meetup.com or go to East Bay Option Traders, we meet once a month and we go through different option strategies. So it'd be wonderful to have you along. Again, my apologies for kind of the confusion on my part calendar-wise. I understand I'm booked for today and Thursday. Thursday's scheduled to be the option part, but what I'm going to give you is abbreviated 2.5-hour CFA class in the next 60 minutes. So if the interest is there, we'll do an informal poll at the end of this. If somebody can coach me how to do Zoom polls, whether you want to learn more about alternatives or if you want to learn more about options, but I'm happy to do both. In terms of alternatives, why these may be important to you in terms of a timely discussion, because equity markets that are all-time highs, bond markets that are all-time highs, because interest rates are so low, near zero. If fixed income markets are trading all-time highs and stocks are all-time highs, you know what investors need? I'm going to hope somebody types in the chat. They need alternatives. You're exactly right. We're going to get underway. So again, some real huge potential here. In terms of your career path, chances are if you're in a newly created job in investments, it's going to be in the alternatives field. I'm not saying a new job to you, meaning if you take an equity position from somebody who retired or left the firm, that's not a newly created job. That's a replacement job. But in terms of newly created jobs, alternatives are really, really where it's at. Goldman Sachs says this is a true trillion-dollar opportunity that's reminiscent of the early stages of ETF growth. I was involved with the early stages of ETF growth, the launch of the iShares. If they are even half right, what a moonshot that is going to be. So that's in terms of why this may be of interest to your career. But in terms of investing, reasons people go into alternative investments are concerns with equity, current valuations of global assets. Again, equities are pricing really rich, especially large cap, mega cap U.S. growth stocks. In bond outlook, you should realize in the way this kind of will fit into your probably collegiate career. If you're a finance major, you'll probably take some accounting and finance prerequisite. Then you'll take an investment elective. And those two are usually the prerequisites for options and alternatives. So again, if you're a bit lost, bear with us. I think the thought process is let's expose you to many fields, and then hopefully if we do generate interest, maybe this is something you want to pursue academically or professionally. But in terms of reasons to invest, rich valuations elsewhere, people need alternatives. Search for low correlated assets to help you reduce your overall portfolio risk in terms of stretching out into more diversified, unique strategies, unique approaches to search for yield, because with equity valuations so high that drives down dividend yields, with interest rate prices so high that generates or lowers bond yields. Again, we're looking for a unique absolute return focus as opposed to a relative return focus in a search for unique strategy.
Hey, Jonathan.
Yep.
Couple of questions.
All right.
What is the issue with rich equity valuations and what does it mean?
Sure. So the higher you pay into something, the lower your expected return. Again, I guess the analogy is when we go grocery shopping, we don't like to pay high prices. We should have that same approach in our stock market trading, whereas if we pay a lower entry price, our expectation for that asset is higher going forward, as opposed to paying a rich price, which most of the realized returns mostly captured in a rich price, so it's lower expected returns. Is that fair to say before I move onward? All right, and in terms of—
Thank you, Jonathan.
You betcha. In terms of alternatives growing, these are some allocations to alternatives from some well-known endowments of the Ivy League schools. Many have 50 to 70% of their allocation to alternatives. You know what the average retail has dedicated to alternatives? Something closer to 5%. Those endowments are really ahead of the curve in terms of having that high of an allocation. Their typical institutional allocation is 25%, but in terms of where we're going to see growth, if that 5% of retail investors, the average investor gets to 25%, that is where that growth curve is really going to happen. And in terms of, is there chat window? Is that how we're getting questions here? Or Michael, if you want to play MC.
Yeah, we actually have two spots, Jonathan. There is the chat, and then we have a Q&A section, and people are kind of going back and forth. We have did you want me to bring the questions up right away?
If you see enough critical mass, I'd be happy to. My fear is
I know that you'll
a bit of a limited time budget.
Okay. All right. So I'll just kind of hold off, but I will just ask you this one: how do we value a stock with no dividend? And we'll go on.
That is probably something better for the equity valuation person than the alternative investment guy. But I think that's a rabbit hole that, in the interest of time, I don't want to try to take on. but again, you rather pay low prices for higher expect. If you have a 12-month target on a stock of $100, you'd much rather pay $20 for it than $90.
Hey, Jonathan, this is a question I was going to ask you, but it was a question from Darian Davis. He says, would it be able to go into the slideshow mode? The slides are quite difficult to read since it's small.
Let me see.
And you just go up to slideshow.
Oh, gotcha.
And go current slide.
All right. Aha. That looks better. My fear is without that little panel there, I'm kind of going live without a net, but we'll see how this goes.
I mean, if we need to go back, then we'll go back, but see what you can do.
Okay. Fair enough. And I'm happy to PDF these and send them to Leon to distribute. So some of the so we'll go through this slide deck. It's the outline of the format of the class comes from the CFA Institute. They have different LOSs, or learning objective statements, and that's what these kind of letters at the top will address. So again, traditional investments, stocks and bonds, is usually a relative performance objective, meaning you're comparing yourself to a benchmark, usually the S&P 500 for U.S. large cap stocks, or the MSCI ACWI All Country World Index for global equities, or maybe the Barclays Aggregate Bond Index for bonds. Traditional mutual funds have generally no leverage. The performance of these products are highly dependent on market returns. So again, there's that saying, a tide raises all boats. So what you're trying to do is pick winners adjusting for those market returns. Traditional assets usually have a fixed fee attached to them, and they offer daily liquidity, if not intraday liquidity, through the use of these exchange traded funds now. Alternative investments, on the other hand, have an absolute performance objective. So rather than compare themselves to a U.S. large cap equity index, they'll compare themselves to some absolute performance of, cash as a benchmark and what it's yielding, or some hurdle rate of a target of 5% a year, 10% a year, etc. The dependence of these categories are usually dependent on some unique attribute of the category. We'll go over the different classes, or the manager's or advisor's skill in the realm of hedge funds. Traditionally, these products have historically low correlations with equities and bonds. A lot of times there'll also be a performance fee attached. So you'll hear a hedge fund quoted as 2 and 20. That means they get 2% of fixed assets and 20% of any performance bonds. The liquidity is usually very tied up into long range investments. When we go over private equity or venture capital, those things usually have an investment horizon of 10 or plus years. But what's nice about these products is they complement traditional instruments in terms of what we want to do in portfolio management is expand the opportunity set, and we do so to one, enhance returns by increasing that opportunity set. There's more potential for high-flying returns, and two, we increase that opportunity set to find diversifying assets, so low correlated assets with your traditional investment. And we'll talk about the efficient frontier, but common characteristics of alternatives is we try to capture some liquidity premium, some segmentation premium. There'll be narrow focus or specialization. There'll be less transparency or regulations. Sometimes there'll be a black box model where you don't really know what you hold because it's proprietary to the fund or the strategy manager. There'll be complex legal structures. So rather than just press a button and buy it at your Schwab custodian, you'll have to sign a good deal of limited partnership agreements or LLC agreements. Sophisticated analysis is usually required to invest in this category. Special tax considerations, especially when we talk about precious metals when we get into commodities. Sometimes data can be biased or scarce, and then there's non-distribution of returns. Here's a sample of my performance at my hedge fund way back when. Our annualized returns were 16% over MSCI China being 10%. Again, 10%, it'd be pretty hard to have a bad Chinese equity market performance in a market that had 10%. But more importantly, we had a higher absolute return, but more important to our investors, we did that at a lower volatility. So again, less squiggle, more smooth ride, smoother and higher is the mantra. And in terms of non-normal returns, not that you can make equity market or global asset prices predictable, but there's a lot of fat tails, a lot of event risk, a lot of skewness and kurtosis if you have your basic stats class, a lot of fat tails, event risk. Not that you can make financial markets predictable, but you can make their range. You can engineer a more predictable range for these categories. And again, it's not just about returns. It's about a lot of different risk metrics when you get into the realms of hedge funds. So my joke is there's the good, the bad, and the non-ugly for you movie fans of reference. The good traits of alternatives are diversification and low correlations to your traditional portfolios, an opportunity to enhance the adjusted return profile, a focus on absolute returns, and means of in terms of traditional investments, if you're, do the example of a Chinese equity manager, if Chinese stocks are down 20%, and you're down only 18%, you're still down 18%, even though you have 200 basis points of alpha. These strategies try to focus on absolute returns. Your benchmark is to not lose money. A lot of unique investment categories in the world of alternatives, an opportunity to enhance yields. Again, in a low yield world, a lot of people are seeking to boost that up, and there's an alternative to the traditional assets. That's the good news of alts. The bad news is they're usually associated with higher fees, lower liquidity, lower transparency, and a lot more complex structure on how these work. So my joke with the CFA members are, because the CFA is 3 grueling years of testing for level 1, 2, and 3 with pass rates of often lower than 50%. So usually it's very rare to get through it in 3 years. So I tell my CFA candidates I teach at level 1, the good, the bad, and the non-ugly. You know what the non-ugly is? It's you, the level 1 candidate. Because right now, I tell them you're as good looking as you're going to be for the next 3-year minimum, because there's a lot of sweat and tears next to them. So bad jokes aside, and I'll probably litter you with a bunch of them, is the categories of hedge funds. And the way the CFA kind of divides up the world is the categories alternatives are hedge funds, private equity funds, which generally invest in private companies, meaning they're not publicly traded. Real estate is often in investable asset outside of the world of stocks and bonds. Commodities, oil, gold and the like. We'll go and look under the hood of commodities. And then infrastructure is, capital long-lived investments for public uses like bridges, tolls, and the like. And other includes intangible and intangible assets. Tangible would be like a stamp collection or baseball cards or fine art, whereas intangible would be like patent law, or there are some hedge funds that are set up on collecting insurance. So if you've been in a bad accident, you get a cash flow. Some hedge funds will help insurance firms make that.
Hey, Jonathan.
Yeah.
Quick question. How do we construct a portfolio with low beta risk? Is that in here? Because you know way more than I do, so I couldn't answer it.
My fear is
Your fear. Okay, I know what your
I don't want
fear
to
is.
go too far down the rabbit hole, but the short answer is if you have a portfolio with market beta 1, meaning 100% invested in equities, the market moves up 5%, you're up 5%, down 5%. The way you want to lower that beta is to add low correlated assets, and that's a common theme of these strategies. And we'll kind of.
All right, Jonathan, that's good.
If you're
That's
a
good,
total,
buddy. Thank you.
you don't really care if the tech sector is, increasing, decreasing, or a low correlation to it. And again, what we're trying to do is strip out the beta of the market returns. In the interest of time, I'm going to kind of skim some of these. But the role of alternatives is to be alpha seeking, and more importantly, to the point of the question, you want to lower the beta or lower the overall market risk. These strategies will have a long range of returns any given years, just because it's such a big blocks. But ultimately, what we want to do is, this is a plot of the efficient frontier. There's risk plotted at this axis, expected returns on this side. Ultimately, we want to be up to the top left, meaning higher returns and lower risk, or how I like to say it, more money and more sleep. Does anybody out there not like money and sleep? Because if you don't, I highly recommend a change in major, because if you're studying finance, accounting, and the like, you are studying the foray of money and sleep. To your question on beta, this is more of a correlation matrix versus fixed income versus equities on this axis. So if you want to reduce your beta to fixed income, you want to find some low correlated asset to the Barclays aggregate. If you want to reduce your exposure to equities, you want to find something with low exposure or correlations to S&P. So managed futures is a popular diversifying asset. And ironically, it's a popular diversifying asset, but it's worked terribly the past few years. And why? Because equities and bonds have really performed well. Again, what you're trying to do is have an asset in your portfolio that zigs when the other one zags. So the thought process is managed futures will start adding value if and when stocks and bonds have a correction or experience a decline. And why do we add different alternatives? We want to raise that efficient frontier. Again, move it up to the left. For each unit of risk, we want to have a higher expected return. Again, money and sleep. And if you attend a lot of these presentations, you'll see this efficient frontier plotted. And I've done a ton of continuing education events for the CFA San Francisco, a lot for the KAYA, the alternative certification, and a lot of continuing education on a lot of fronts. And you will see this slide quite often, the efficient frontier plots. And if you add just a little bit of this uncorrelated asset to your traditional assets, you will stretch your efficient frontier. And in terms of this traditional 60-40 portfolio of 60% equities, 40% bonds, people are really starting to carve out into more alternative assets. So the old pie chart was twofold. The new pie chart will have 3 colors, but when you look under the hood, a lot of these characteristics are kind of equity alternatives or fixed income alternatives, or at least some kind of correlation with it. And even to the example of the toll booth, I said had low correlations to the tech sector. But think about the toll booth operator at the San Mateo Bridge versus one out in Omaha, Nebraska. The one in the San Mateo Bridge will actually have a correlation to the tech industry because when I go from Oakland, Hayward, San Ramon, I pay that toll on the San Mateo Bridge to get to Silicon Valley and the like. Here's a project I did for Wisdom Tree. I plotted some of their correlations. Again, what's better than low correlations is negative correlations. That's a full zig with the other zags. But again, what we're trying to do is build efficient strategies. And Leon, how much time did you budget for this? Because I kind of want to go through the big five. I don't have to get into all the details, and I want to be mindful of the time. And I'm happy to stay later, given that I joined a little bit later. But what time did you have budgeted for this event?
So technically the meeting ends at 3:30, but feel free to have 15 more minutes added to that. Okay.
And again, I'm kind of happy to go over this on Thursday as well. And again, my apologies for the confusion on my part. So the categories we're going to go over are hedge funds, private equity, commodities, real estate, and infrastructure are the big wigs. In terms of hedge funds, back in the day, it used to be, true strategies that were hedged, whereas now it can be nearly anything under the box. So just some highlights are, again, the absolute return structure as opposed to a relative return. More complex legal structures, the limited partnerships, limited liability corps, so offshore funds. Hedge funds have a lot more flexibility than traditional mutual funds. They can use leverage, short selling, derivatives, options, and liquid securities. And again, the fees usually have a performance fee attached. So one, a fixed fee, two, a gross fee attached. There's many subcategories of hedge funds. And because I did a project for Wisdom Tree, they had a launch of alternative exchange traded funds. So if you want to do some research on these tickers, if any of these look of interest. The 5 subcategories of hedge funds are long short funds, meaning they will take a long and a short position. When you take a long position, you expect an asset to rise. If you go short a position, you expect the asset to fall. Market neutral funds. So the example of a long short fund will be, there used to be something called the 1-30-30 strategy. So if you had $100 million, you would invest $130 million in your long stock portfolio, and you'd be short $30 million for a net beta of 1. But again, you want to capture alpha on the long side with your longs and the short side for positions you're bearish on. Market neutral funds will have a net beta of 0. So if you're long $100 million, you're also short $100 million. And the benchmark of that strategy would be cash. So again, if you want to, the thought process is if I can make 2% on my longs and make 2% on my shorts, I should be able to generate 4% return with a net position of 0, but being the benchmark being cash. So the same net exposure of cash, which is yielding close to 0, these alpha managers who have skill in selecting stocks to go long or short think they can capture 4%. And in the extreme example where we talk about adding leverage, if you have $100 million in assets, but you're long 400 million and short 400 million, you're expecting that 4% to be 16% if you can really add value and cover the second lending derivatives. Global macro funds are amongst the most volatile strategies. They have a huge tool set. They'll trade commodities, currencies, equities, fixed income products, almost anything under the sun. There's also event-driven strategies that try to capitalize on mispricing or company-specific news. These may be merger arbitrage funds, or a strategy like the put right, which try to capture higher implied volatility over realized volatility. Some big or some pricing edge in these events that these managers have a skill set in. And then the fifth category is fund of funds, meaning you are a sub-advisor instead of a portfolio manager at BlackRock being on the equity side, holding hundreds of stock underneath. These fund of fund managers will be a holder of specific hedge funds. So what they'll do is they will allocate to different hedge funds. So if I'm a $100 million hedge fund manager, I may invest 10 in a global macro manager who I'm familiar with and have success with, or a merger arbitrage manager, or an activist hedge fund, or again, we are a collection of, we manage positions of hedge funds or alternative strategies. The benefit of fund of funds is more diversification. You get access to funds that are traditionally closed to the average investors. You're a real expert in analyzing these funds. That commands a premium to the skill set. And again, a low correlation with securities. The drawback is usually you're a manager that charges a 1 in 10% fee structure on top of a bunch of funds that charge 2 and 20. And when you take that much fees away, it's a high bar to capture. And there's also behavioral biases in these fund of funds. This was a fascinating ETF fund of funds. They prided themselves on having an ETF structure, an exchange traded fund structure, but they held a lot of assets within the structure. So even though ETFs are categorized as being low fee, the fund of fund manager was certainly below 1 in 20, but when you add up their expense ratio and the fees on top of the fund fees within the ETFs they chose, it was close to 2%. So again, really tough hurdle to justify such high management fees. Another unique risk for hedge funds is a lot of leverage are used. There's even the use of derivatives, which not to go too far into the operational hood, but has T-reg requirements, meaning if a T-reg for a index future is 5%, that means you could put down, have a 20x leverage exposure before you had a margin call, meaning you put $5 million down to get $100 million worth of exposure based on the leverage involved in derivatives. Different unique risks. Again, these are not your average mutual funds we can look up in a paper or online every day. A lot of liquidity risks. Pricing risk can be static. Counterparty risk, especially when over-the-counter swaps are involved, settlement risk, a lot of unique risks that you don't traditionally encounter in traditional long-short investing. A lot of biases in the hedge fund performance metrics themselves to be aware of. Again, heavily tested in CFA, less so here. Just be aware that whenever you see a hedge fund index reported, it's usually overinflated returns and the risks are understated. So just take precaution if you end up becoming a fund-to-fund analyst who chooses managers, and just be very aware of the asymmetric risk. So again, a lot of unique stuff that maybe as undergrads, maybe a little bit above scope to capture, but some definitely noteworthy items you have to perform due diligence on that you wouldn't ordinarily have to within traditional equities and bonds and mutual funds. There's a lot of heavily tested CFA calculation is the calculation of fees. In the interest of this presentation, just know hedge funds charge high fees and command a lot. And I will say that if you do want to one day work for a hedge fund, this is kind of a fun slide. A master's degree will help. The CFA will certainly help position you, because these are some of the degrees that are most sought after when hedge fund managers use placement agents or job futures. The bonus section is managed futures. It's a unique strategy in the fact that rather than own stocks and bonds, they are certified CTAs, or commodity trading advisors. Again, this for managed futures, know that the opportunity set is vast. stock indexes, interest rate products, foreign exchange, agriculture, cocoa, milk, pork bellies, metals, copper, lead, gold, energies of crude oil, just a huge, huge playing field for these. And what they ultimately promote to the person who asked about lowering the beta is, again, when stocks and bonds go through struggling times of rapid inflation, managed futures work out pretty well. Gulf War, stock market crash, the Russian default, tech bubble, credit, even in this most recent coronavirus sell-off, the one thing that really helped our investors, we had a small allocation to managed futures. Again, they zigged when the market zagged to the downside. And what these things really want to show is value add over the long run, but being risk compensating. And then when you add these to a diversified portfolio, you lifting upward and outward in terms of higher returns and lower volatility. Private, any questions on hedge funds? I'll depend on Michael and Leon to MC.
We do have 3 questions, but I'm not quite sure if they're hedge fund related.
Okay.
So, I mean, you can take a look at them if you hit the Q&A, and you can see if there's any that you want to answer right now.
Algorithm. The question about algorithm, the short answer is yes. A lot of hedge funds are really using a lot of algorithmic high frequency positions. An example of a fixed income alternative investment, that would be like private lending. So if you're familiar with Lending Club or what are some of these ones? Lending Club, or there are a lot of people who are, when the bank, there's a segment of the market, when the bank says no, we say yes. They're alternative lenders. That would be an alternative to a traditional fixed income debt security.
Hey, Jonathan, are those high interest? You're paying a higher interest rate, right?
Yeah. So if the bank says no and they say yes, they're not doing it out of the
goodness of their heart.
They adjust, they price that risk in, yes. High yield fixed income have a correlation with zero coupon. I'm going to guess yes, because there's some interest rate risk component to nearly any fixed income security. And the 3 main leverages for hedge funds. Let me scroll back. And I can send this. Accessing margin, borrowing funds externally, and then using derivatives are the 3 ways to kind of lever up your limited partnership hedge funds. Private equity, again, these are firms that specialize in investing in private companies, meaning non-publicly traded companies. The structure is usually a limited partnership with the general partners being the operators or the decision makers, and the limited partners being the investors. And the limited partners essentially gives the general partners money to invest on their behalf to seek a profit over the long run. More and in general terms that are tested on the CFA, probably not likely for this, but the subcategories of private equity are venture capital, meaning investing at angel ideas all the way up. Again, before Snapchat was a publicly traded company, it was somebody's clever idea saying, how do we bring these communities together? And then eventually, how do we monetize it and get funding for such? Developmental capital represents investment in more minority investments in more larger mature companies. And this may be a private landscaping company or a painting company or some kind of construction firm that's not publicly traded. Leverage buyouts use debt financing to acquire different non-public firms, or sometimes they'll buy public firms and take them private. And then there's distressed investing, buying the debt of mature companies with the objective to turn them around. Fees, again, one thing that was important on private equity was hedge funds charge on invested capital, or if they have 100 million of net asset value, they charge on that. Private equity is unique in the fact that they will traditionally call investment. So there'll be traditional private equity horizon is over 10 years, and you don't have to put that money to work right away. There'll be called capital in years 1 through 3 or 1 through 5. But say if I have a $10 billion fund, I'll raise 5 billion out of gates, or maybe 4 billion out of the gates, then I'll raise 2 billion for the next 3 years to get to that 10 billion. I don't have 10 great ideas right at once. Sometimes deal flow comes to me, but the life of the fund early is I will call that capital for investment in the next 3 to 5 years. However, private equity funds typically charge on committed capital. So even though I only have $5 million in my bank account looking to use private equity deals, I'll charge fees on the entire 10 billion. And then there are some other details about clawback fees. Like I can't earn a performance fees until my original investors are made whole in their investments. Different stages of private equity, not pure, but usually see the seed startup stage.
Hey, Jonathan, if you don't, we are going to have a session on private equity, which is going to be done by one of our alumni. I believe it's next week. And that's, so if you, I know you got a lot of stuff in here. If you want to just kind of touch on it real quickly, and we'll go into more detail when Ben presents this.
Yeah, fair point. I'll defer to his expertise. But the main points are, why do people invest in private equity? Opportunities that are out there, not in the public market, a unique opportunity. These uniqueness usually has a low correlation to public equity, so it's very attractive in terms of a larger investment portfolio, access to information, potential for control. So again, a private equity investor, it's one thing to collect a check from a private equity investor, but what's really nice is to take a check from a private equity investor who opens up their Rolodex to you and helps you succeed and find investments. Ongoing involvement, again, the general partners are really involved with these companies because they want to see them succeed. And again, why do we invest? It's an increased opportunity set to, 1, enhance returns, and 2, reduce risk through its diversification. And traditionally what happens is we give venture capital money in the beginning, knowing that there's going to be a high burn rate before they start creating revenue, and hopefully that revenue will get to a point where it will explode. This is just a few years ago, but private equity is a booming market, a very booming market. And the traditional private equity fund, again, if I have $10 billion, I'll invest $1 billion in 10 companies. And the traditional private equity model is 8 will fail, 1 will kind of teeter-totter, but you really hope that 10th is the next Google or Snapchat or Facebook idea. That where you get, you're content losing 90% of your portfolio if that 10% gets you 50x, 20x return, 50x return. So I will defer to the private equity expert. I think, and if there's a real estate guy, I'm happy to kind of fly through this. But again, real estate's unique to stocks and bonds because it's such a unique asset, great diversifying potential, a nice hedge against inflation. But again, a very unique asset class in the fact that they're generally very illiquid. Meaning these things don't trade every day like stocks and bonds. They're difficult to value because of the uniqueness of the indivisibility or the immovability of these assets. They're subject to high transaction costs and management fees. A lot of market inefficiencies that are certainly coming, not going away, but being reduced with the adage of fintech, like Zillow comes to mind. There used to be a lot of difficulties in obtaining information. During this quarantine, my teenage daughter has been watching a lot of horror films, and you'll notice the Amityville series is out of Rhode Island, which interestingly, the state of Rhode Island does not require the disclosure of violent deaths, where in California you have to disclose any violent deaths in real estate homes. So some very unique aspects of real estate, and a lot of different ways to access real estate on the private and public side, and on the debt side in exchange for a coupon or fixed rate or an equity ownership portion. So examples of private debt are mortgages and construction lending, unique to the individual or the company. Public debt is the collection of vast pools of these mortgage-backed securities, or CMOs, collateralized mortgage obligations.
Hey, Jonathan, wasn't it these combination of these mortgage-backed securities that caused the crash in 2008? Wasn't that a big part of it?
It was a big part because the leverage involved was really out of whack. But yes, some really, again, I think, I don't know why this movie's escaping me. Oh, The Big Short. If you want to learn more, The Big Short is fantastic.
It's really good, people. That's a good one.
And the guy who was the guy from The Office's character, he spoke at the CFA San Francisco.
Steve Carell?
The guy Steve Carell plays actually spoke.
Oh, yes, he was the speaker a couple of years ago. The one time I went.
Yeah. So, in terms of alternatives, what was one of the big unique characteristics? A lot of leverage. So again, please be aware of the leverage used in these things. Private equity, a private equity investment would be like you owning your house. A public equity investment would be you owning shares in real estate investment trusts, home builders, and the like. 4 common approaches. This would be heavily tested on the CFA. But basically, you want to take a look at some kind of income rate over some hurdle you require to find out. Again, if you have not taken your finance class yet, you'll soon be introduced to NPV, net present value, IRRs, internal rates of return, and the like. However, sometimes things can be pretty simple. And again, I mentioned Zillow back in the day, and this was probably my old neighborhood, probably 10 years ago. But I lived in one of those mixed housing developments where 20 years ago it was just rolling green hills, and then the construction companies kind of flattened everything and played SimCity, building residential school, residential police station. And because they're so uniform, it's very easy for Zillow to kind of come up with a very accurate price, as opposed to a neighborhood that was built uniquely in non-tract housing, in the middle of Montana. So again, this fintech is really increasing the efficiencies, but again, we're not quite fully there, uniform valuation and due diligence yet, because all the different regulatory rules between states and counties. But over the long run, compared to global equities, if you invested back in '93 and finished in 2016, a very attractive return, but not like real estate. And what's really unique about real estate investment is how much money comes from income. So again, if you are an income sensitive investor, maybe you want to lessen your exposure to real estate. Or if you have a qualified non-taxable retirement account, maybe that's where you want to stuff some of your real estate investments in, just in terms of what you want to be aware in these alternative investments is where the return is coming from, and just be aware that for real estate investment in public markets, a good chunk of it comes from the income or dividends paid. And why do we invest in real estate? And hopefully this is sounding like a chorus now, and it's kind of the CFA or the finance realm's Bon Jovi moment. When Bon Jovi croons, "Shot to the heart, you're to blame, you give love," and he hands the microphone to the crowd, and what do they say? Any Bon Jovi fans out there? Am I dating myself?
They're too young, Jack.
they scream bad name. Please tell me somebody typed in "you give love" a bad name in the chat window. But that's the CFA mantra. Why do we investigate in these unique strategies, alternative asset sets? One, to enhance returns by investing in an opportunity set with either potential for steady returns or high returns. And two, the chorus is reduce risk. We want to invest in low correlated assets to lift our efficient frontier or investment portfolio. Where do we want to go? We want to go up to the left, higher returns, more money, upward, and then to the left of volatility. Less volatility means more sleep. So the Bon Jovi moment, more money, more sleep. Expanded opportunity set for returns, lower correlated assets to reduce risk.
So Jonathan, do you have something, you know, now maybe these kids, young adults, remember, oh my God, I can't think of the rapper right now, but his thing was Mo Money, Mo Problems. And I'm sure the kids know who I'm talking about. It's Biggie Smalls.
Oh,
Anyways,
yeah.
couldn't help myself. I'm sorry.
He had half the CFA curriculum right. He got the more money. See, what he was good at was finding money. You know what he needed? A good risk manager so he could have more sleep or less problems. So any questions on real estate before we get to commodities? Again, I'll try to wrap this up in 10 minutes. And I'm happy to do a more deeper dive Thursday, but I think Thursday will be unique in the fact that I will talk about an option strategy. So I will expect you guys to have some foundational knowledge. And I know you guys have a range of undergraduates. Some are seniors, some are freshmen. So again, my categories kind of expect you to at least take your basic finance class, if not your basic investments class, which is usually the core of a finance major. Then you can take varying electives. Some will be risk management with derivative securities or derivatives class in its own right, or an alternatives class in its own right. It kind of depends on the curriculum of the school, but that's usually the foundation. So the hope is, if you're lost, please know that in a few years, what this hopefully will do is like, oh yeah, I remember being introduced to that through the Street Smart program, or who knows, maybe it kind of causes a lift in your interest. So again, categories of alternatives: hedge funds, private equity, real estate, and now commodities. Let me take a quick timeline if I can find the Q&A, see if anything's popped up. I will send this to Leon in PDF form to get you guys. Is there any questions? Algorithm.
I think we got them.
Okay. Oh, and I will say, I'm a coach by nature. I've coached over 35 seasons of youth sports. I've mentored countless CFA kids and students. Please reach out to me on LinkedIn. It'll be fun to hear what's next for you guys. And the hope is next summer, if you guys are still in the program, I do a live trading game, which is
Oh yes.
Zoom.
Oh yes.
The fun capital markets exercise, I think, would be a lot of
fun. So Jonathan, do you still have the same rule that you used for me? Is that you had to know who the person was before you would accept their connection?
For LinkedIn. Oh, well, yeah. If you send me a blind invite, you're gonna get a very snobby email from me saying it's been a lot of years, a lot of miles. Can you help refresh my memory? So please don't just send me.
That's how we met.
Don't send me a generic.
That's how we met.
Yeah, exactly. Don't send me a generic invite. I'll call you on it. But just mention you got this through Street Smart, so the sponsoring. Help me connect. I don't accept blind invite. But yes, fair point. Fair point. And that should be a lesson to your kids. You want to network and connect the story. Just don't blind invite people. So it's very easy to not. People like to keep their networks pure. They don't like to accept it from just anybody. Commodities, there are passive investors. We use it for the negative correlation risk reduction. And then there are active investors who really look to exploit pricing inefficiencies. Again, what's a perk about commodities is it tends to be an inflation hedge. Again, you may have seen the headlines of gold and silver really screaming the past few weeks, and it's in no small part because of all the fiscal stimulus and money that the Federal Reserve and Congress is splashing or throwing at this coronavirus problem. There's a lot of anxiety about what it's going to do to inflation. Let me just show you a chart of gold. here's kind of the correction of gold during the coronavirus, and then after the stimulus was announced, an increase of over 50%. If that doesn't impress you, maybe silver's return of.
Hey, Jonathan, is that a screenshot of a Bloomberg terminal?
Oh, I'm sorry. This is my Thinkorswim system.
Okay.
From TD Ameritrade. So I run a book of business. My custodian is TD, and this is one of the tools they afford us. And this technical analysis and the like. And then if the silver doesn't impress you, it should impress you. It's just been remarkable. If you think the gold return is nice, just take a look at the gold miners of almost 2.5x. In no small part because commodities are kind of categorized as an inflation hedge. And why this makes for a nice fit into your traditional asset portfolio is whereas a lot of equities are tied to equity market returns, or bonds are tied to interest rates. Commodities have very unique risk premiums attached to them in terms of storage capacity, overall supply and demand. Weather can really affect a commodity like a crop like orange juice. When there's a freeze, it usually spikes supply and demand returns. But the reason we invest in commodities, you can close your eyes and just read me that Bon Jovi moment. We increase it because of one, gives us an opportunity for greater returns, but more importantly, an opportunity to diversify and lower risk. A lot of different ways to approach commodities. You can do it through futures, option swaps, derivatives. There's also exchange traded funds, managed futures funds. And then if you don't want to invest in the commodity themselves, like silver or gold, you can invest in gold miner stock. Or if you don't want to invest in timberland, you can invest in paper making companies. Again, there's a lot of sector related projects. If we a heavily tested project in the CFA exam is the components about how the futures trade, really unique, and how you have to factor in. If you invest in oil, there's a cost to that, right? Because if you owned oil, you would have to pay to store it, and that's priced into these futures pricing. So it's something to be very aware of. Then if you're investing in a commodity index, these are much different than a stock index and how they're constructed. So just buyer beware what you're getting. You tend to want to be more diversified than less diversified. So these are two examples of ETFs. Any questions on commodities? And here's commodities does appeal to you, and I think a lot of these students dialing in are from Diablo Valley College in Pleasant Hill area. U.S. Commodity Funds runs USO, the United States Oil Fund, which is like $2 billion of assets, and some fascinating happenings in the USO ETN. I don't know if people remember that oil went negative price, meaning people would pay you to get rid of their oil rather than you pay them to take it off. In terms of a shock, it was remarkable. But that U.S. Commodity Fund was headquartered in Oakland. They recently moved to Walnut Creek. So, in your backyard, if you want to reach out for more information, there's some very good people at U.S. Commodity Fund. But again, some real fascinating happenings in this recent world.
Jonathan, is it possible we can continue the fifth topic of infrastructure on Thursday?
I think that's very possible, yeah. And we'll go from there. So, Leon, my humblest apologies about confusing the days. I knew I was on for Thursday. I did not read the fine print for Tuesday, so my apologies for my late start. I will send you PDF slides of this, and I will also, if you can do a little bit of research on put call. So I teach risk management with derivative securities for UC Berkeley. I was supposed to teach downtown this summer, but then everything got moved online and nobody enrolled. But I will share you the basic slides of my first options class for you to review prior. And if I'm racing off, Leon, you'll have it by tomorrow. If you don't have it from me tomorrow at 9, can you send me an email to refresh?
Definitely, I'll make sure.
because I want to make sure you guys, one, get these slides for your own reference, two, get a bit of an introduction to basic options concepts. But we will be talking about buy right strategies, which
Hey,
the
Jonathan, there's
top
one question in the Q&A.
all righty.
I think this is my buddy Miguel in Chicago, I think.
Okay. Is he a student?
He was at, yes, a student, but he was an intern at Pinsera in Chicago.
Is this his question?
How do people determine? Do you see it?
Oh yeah, plants, mineral, tradable. There is a lot of them. I think if he had saw the slide on managed futures, I kind of outlined the playing field, and he asked, "Is there limitless?" And I'll agree there is a lot. And if he wants to look at specifics, this slide 42 details. Not every market is traded, but there's a ton of them out there for sure. And then, but next time we'll talk about short volatility strategies, how they're constructed. Oh, let me put this in the chat window. We'll go through one of the most risk efficient institutionally accepted strategies. I'll send up in this link. I'll CBOE buy right. I'm gonna put this in the chat window. I'm smart enough to find the chat window. Q&A answered. Michael, do I have access to the chat? Oh, here we go.
You should.
Oh, here we go. Oh, God. I'm sorry about that.
It costs extra for that, Jonathan.
There you go. Take a look at this research, but the 4-pager you should read is Ibbotson. This buy right paper. It is 4 pages. It will probably take you 6 minutes to read. It's mostly graphs, but again, why do we invest in these alternatives? Short volatility, institutionally accepted strategies, more money in the forms of annualized returns, and more sleep in the forms of less fall. So again, take a look at that. That's the 4-page version. There's also a 6-pager. Let me see. What? Moran. The 4 pages should be enough, but again, I think there's no short. Again, if you are a finance major, your academic year is coming up, so no more Diane Steele romance novels. Start taking a look at some of these white papers, kind of get your mind in the academic realm that you're going to be thrust upon in the next couple of weeks. God willing, with everybody going back. But Leon, be on the lookout for those 2 PDFs. One on alternatives. The second one will be my basic option class that I'll kind of expect you guys to get through maybe the night before, or the afternoon before Thursday's 2:30 schedule. And I will let you know, I put a note to myself. I will be there early on Thursday. Again, my apologies for overlooking this here.
Sounds good. Everyone, I just want to thank everyone for coming. Of course, it was like small little errors today, but you can expect that in any first time program, since this is our first time hosting this summer program. And I just want to give a small update how I will post another link of our LinkedIn. There we're going to post all of our updates as well as all our recorded videos, but I'll make sure to post this specific video as well on your individual emails the following day, which is tomorrow, as well as Jonathan's all his presentation and his information set up over here. Thank you for everyone for coming. Feel free to leave. It's been a great time. Again, have a great day. And thank you again.
Go ahead, Jonathan.
Oh, Michael, thanks for the audience. And Leon, bravo to you. I remember this was a night. So just a little background on Leon and I's collaboration. I did, Merrill Lynch does a lot of summer internships, and they're always good. But what they did that was really great, the San Francisco Merrill Lynch interns. They would pull the interns back once a week to have learning sessions like this. So Merrill Lynch San Francisco is huge. There's sec lending, there's bank lending, there's venture capital group, there's stocks and bonds, of course. And these kids every week for 10 weeks got a 10-week program specialized on Merrill Lynch. And I quoted that by Leon saying, oh, maybe you could do 4 or 5 this summer, maybe 10 next summer. But I saw the sketch of your agenda, and I thought it was very ambitious and very well done. And I'm very impressed with how many topics you've done to your peers. So again, kudos to you, Leon.
Yeah, I'm impressed with Leon too. He's done a fantastic job. And Jonathan, we love you, buddy. So thank you for, coming on here with us. And I know you'll be here on Thursday.
Always happy to help. I think your cause is really noble and it's something I'm passionate about. So happy to help.
All right.
See you guys.
Thank you.
Bye, Jonathan.